Have you ever wondered who actually keeps the world running?
I mean, usually people think it's tech CEOs, right? Or, politicians.
Exactly, but it's really not. Like, if the power grid flickers for just one single second at a major AI data center, it can cost millions of dollars in lost compute time.
Oh, yeah. Massive data corruption. It's a nightmare.
Right. And the people preventing that disaster, the ones managing the multi-million-dollar battery backups and the critical cooling systems, they aren't Silicon Valley software engineers. They are wearing facility maintenance uniforms.
Yeah, the people making sure the lights stay on, the airport terminal is clean, the microgrid is actually functioning.
Exactly. So welcome to this deep dive. Today we are looking at this invisible 100,000-person army keeping the modern economy from collapsing.
It's a massive scale.
It really is. And our mission today is to read between the lines of a fairly dense corporate financial report. We're looking at the Q2 2026 earnings presentation and press release for ABM Industries. This is dated June 5, 2026.
Right, because earnings reports like this one, they function as economic treasure maps. If you follow the capital flow within a massive diversified services company like ABM, you aren't just evaluating a single stock.
No, you're looking at the big picture.
You're watching the global economy breathe.
Yeah.
You can see exactly which sectors are scaling up physical infrastructure and which ones are quietly retreating.
Okay, let's unpack this.
Yeah.
Because the core reality of ABM is that they are an absolute invisible giant.
Like very invisible.
Yeah, we're talking about a company with over 100,000 team members. And in just 3 months, the second quarter of 2026, they generated a record revenue of $2.3 billion.
Which is wild. That's up 8.4% year over year.
Right. But to understand how a company makes $2.3 billion, mostly behind the scenes, we can't just look at that top-line number. We have to look at the specific sectors that are surging, which tells us exactly where the global economy is heating up.
Yeah, and the growth isn't really coming from where you'd expect. Like, let's look at their aviation segment. It saw a massive 19.5% revenue growth.
Wow. Almost 20%.
Yeah, and the sources attribute this to really healthy domestic air travel, plus they're ramping up some huge new contracts. They specifically call out a major win at London's Heathrow Airport.
Which is huge. Winning a contract at Heathrow, that means taking over the operational logistics of what is basically a small, highly regulated city.
Exactly. But then you look at their technical solutions segment, or ATS, and that's where the numbers start to look like a tech startup.
Yeah, I saw that. This division just exploded, right? 27.2% growth.
Yeah, over 27%. And the drivers for this were a $100 million plus microgrid project win, battery energy storage systems, data centers, HVAC services.
Okay, but wait. I have to push back on this narrative a bit. When we think of facility management, we usually think of janitorial services.
Right, mops and buckets.
Yeah. So is ABM essentially wearing a disguise here? Like, if I'm building a billion-dollar AI data center, why am I trusting my mission-critical battery storage to a company historically famous for emptying trash cans? Aren't there highly specialized engineering firms for that? They seem less like a janitor and more like an engineer with a high-voltage battery pack.
Well, what's fascinating here is how ABM has actively acquired and built out that exact engineering expertise. They're trying to shed that janitor label.
Oh, so they bought the expertise.
Exactly, because the traditional view of facility management is just reactive maintenance. You clean up a mess or you fix a broken pipe.
Right.
But look at the mechanisms driving that ATS segment. They are leaning hard into the infrastructure of the future. They're providing clean room services and downtime prevention. For a modern data center, HVAC isn't about keeping office workers comfortable.
No, it's about keeping the machines alive.
Right. If a server farm running complex language models overheats by even a few degrees, the entire system throttles down or crashes.
Right.
So ABM is installing and managing these microgrids and battery storage systems that act as absolute mission-critical insurance against grid instability. They are actively preventing data loss.
Wow. So they aren't just cleaning data centers. They are essentially selling uptime to the tech industry.
Yeah.
That totally explains the massive revenue jump.
It does, but there's a surprising contradiction in the aviation numbers we need to look at.
Oh, right. The frictional costs.
Yeah. Revenue was up almost 20% in aviation, but the report explicitly notes that the profit margins faced fictional costs from adverse weather and TSA inefficiencies early in the second quarter.
Meaning they had more customers, but it didn't automatically mean easy money.
Exactly. This is where the reality of managing a massive physical workforce collides with a spreadsheet. In an office setting, if a project is delayed, you just send an email.
Right.
In aviation, if a massive storm rolls in or, say, TSA checkpoints are backed up for 4 hours, flights are grounded. But ABM's workforce, the teams handling passenger assistance, cabin cleaning, shuttle operations, they are still on the clock.
Ah, I see. You can't just send thousands of workers home and tell them to come back when the sky clears. They have to physically be there waiting at the gate for the planes to finally arrive.
Exactly. So you are paying for labor that is sitting idle. And that's due to external bottlenecks entirely out of your control. That idle time eats directly into your profit margin.
That makes total sense.
It proves that a surge in consumer demand, like more people flying, doesn't translate to higher profits if the physical infrastructure of the airport can't process that volume smoothly.
Which proves that sometimes taking on more customers or more work is actually a trap. And that exact lesson, knowing when to walk away from a job, is playing out aggressively in ABM's most traditional business sector.
You're talking about business and industry.
Right, the B&I segment. This is their largest sector by far. It generated just over $1 billion in Q2. Yet the organic growth rate for B&I was completely flat, just 0% growth.
Yeah, but that flat line hides a strategic retreat, because the report highlights strong growth in the UK, but that was entirely offset by ending a major contract with Transport for London mid-quarter.
Right.
And crucially, the sources explicitly state that ABM intentionally exited several client contracts on the West Coast.
Wait, intentionally firing paying clients?
Yeah, because those clients didn't meet ABM's margin hurdle rates. The report also flags the ongoing risk of decreased commercial office space utilization due to hybrid work models.
I mean, imagine intentionally firing your own paying clients. Is dropping these West Coast clients a sign of an industry in trouble because of the work-from-home era? Or is this a sign of a company acting with just ruthless efficiency?
It's actually a classic margin protection strategy. It's a brutal mathematical trap for facility management right now. Think about a massive office tower in a West Coast tech hub. Because of hybrid work policies, that building might only be, say, 35% occupied on any given Tuesday.
Right, the empty office problem.
Exactly. So the building owner, who is ABM's client, they're losing lease revenue as tenants downsize. So what do? They pressure ABM to negotiate a cheaper maintenance contract.
But a building doesn't scale its cleaning needs perfectly with occupancy.
Yep.
You still have to run the HVAC for the whole floor. You still have to clean the lobby, the bathrooms, even if only a third of the cubicles have people in them.
Exactly. And ABM's labor costs are fixed, or they're rising due to inflation, while the client's willingness to pay is dropping.
Okay, I see.
So when the math inevitably breaks, the profit margin drops below ABM's internal hurdle rate. That's the minimum return they require to justify the operational headache. So rather than fighting a losing battle against empty office buildings, ABM is reallocating its resources.
And look at where they are moving those resources.
Mm.
The report shows their education segment just secured a $25 million plus win with Detroit Public Schools.
That's a solid long-term contract.
Yeah. And their manufacturing and distribution segment, M&D, grew by 16.5%. A huge driver of that growth is semiconductor manufacturing expansions.
Which is a massive margin opportunity. I mean, contrast that. Why fight for low-margin office cleaning when you can clean a semiconductor plant?
Right, because a semiconductor fabrication plant requires incredibly specialized cleanroom environments. We are talking about microscopic particulate filtration, super rigid sanitization protocols.
Yeah, because a single speck of dust can ruin $1 million silicon wafer.
Exactly. So the profit margins for executing that level of precision are significantly higher than just emptying recycling bins in a half-empty corporate high-rise.
It's a huge difference. And the CEO, Scott Salmirs, specifically called out their recent acquisition of a company called WGN Star as contributing meaningfully to that M&D growth.
Which again proves they are buying the specialized expertise needed to capture this high-margin market.
Yeah. ABM's willingness to ditch unprofitable clients shows a really strict focus on the bottom line.
It does. But speaking of the bottom line, recently, a major government regulator stepped in and forced them to completely change how they calculate that bottom line.
Yeah, the SEC. We have to look at the financial plumbing here.
Right. So let's look at the facts from the SEC and the books. ABM reported a GAAP net income of $43.1 million, or 73 cents per share.
And GAAP stands for Generally Accepted Accounting Principles. It's the baseline rules.
Right, the standard rules every public company must follow.
Oh.
But ABM also highlighted their adjusted net income, which was much higher. It was $52.9 million, or 90 cents per share.
Yeah, pretty big jump.
And they are reaffirming their 2026 adjusted earnings per share outlook of $3.85 to $4.15. But there is a major caveat buried in this release. Following communications with the SEC, ABM had to revise the definition of its non-GAAP financial measures.
Basically, they had to change what they're allowed to call adjusted.
Yes. They can no longer exclude prior year self-insurance adjustments from these adjusted numbers. We're talking about changes to reserves for general liability, workers' comp, things like that. So what does this all mean?
It's complicated, but it's important.
Right. Imagine running a massive national delivery company with 10,000 trucks.
Yeah.
Every year you get a certain number of blown tires. When reporting your profits to investors, you try to subtract the cost of those blown tires, claiming they're, random accidents.
They don't reflect your core delivery skills.
Exactly. But the SEC finally steps in and says, no, if you drive 10,000 trucks, blown tires aren't an anomaly. They are a fundamental cost of doing business. You have to include them. It's like a referee changing the scoring rules in the middle of a basketball game.
That's a great way to put it. And if we connect this to the bigger picture, it highlights the tension between how a company wants to present its health, excluding messy insurance costs, versus how regulators demand transparency. To understand why the SEC cared enough to intervene, you have to look at how self-insurance actually works for a company of this scale.
Because they aren't just buying a standard commercial insurance policy off the shelf.
No, not at all. With over 100,000 employees doing physical labor driving shuttles, maintaining high-voltage systems, they manage their own risk through self-insurance reserve funds.
So they're essentially setting aside their own pile of cash to pay out claims when someone slips and falls or an ABM truck backs into something.
Exactly. And the accounting gets complicated because an injury claim from an incident in, say, 2023 might take 3 years of litigation to finally settle.
Oh, well.
So in 2026, ABM might realize that old claim is going to cost $2 million more than they originally estimated in their reserve fund.
Okay, I see.
Historically, ABM was taking those adjustments for past year incidents and excluding them from their current adjusted net income. Their argument was likely that a surprise medical bill from an old 2023 lawsuit shouldn't make their core operations in Q2 2026 look artificially bad.
Which is a very convenient way to keep the current quarter's narrative looking clean.
Highly convenient. But the SEC's counterargument is structural. Managing an army of physical workers inherently involves a continuous rolling wave of accidents and liability adjustments. You can't treat the cost of managing human physical risk as an anomaly.
It's the bedrock reality of your business model.
Right, so those ongoing adjustments must stay in the adjusted profit metrics.
But, despite this accounting headache, ABM's actual cash position is incredibly strong. You can't fake cash in the bank. In Q2, their free cash flow was $22.4 million.
Which is huge.
Yeah, that is up 47% from the exact same time last year.
A 47% jump in free cash flow is a massive signal of operational efficiency. Free cash flow is the money left over after a company has paid for all its daily operating expenses.
Right.
And the report notes this improvement is heavily tied to the implementation of a new enterprise resource planning system, an ERP.
Okay, so for the listener who hasn't suffered through a corporate software rollout, how does an ERP suddenly generate a 47% jump in cash?
Well, an ERP is basically the central nervous system for a company's data. When you have 100,000 employees, you are billing clients for millions of fragmented man-hours. If your legacy billing software is slow, it might take you 45 days to accurately invoice a client.
And then another 30 days to actually get paid.
Exactly. An ERP integrates all of that. It tracks the labor hour, generates the invoice instantly. You collect your receivables weeks faster. The work hasn't changed, but the speed at which that work turns into actual cash in your bank account accelerates dramatically.
So they're just getting paid faster.
Yes.
And that acceleration is giving them serious financial leverage. Their total debt leverage is currently at 3.2 times, but they are explicitly aiming to bring that below 3.0 times by year end.
Right, systematically paying down debt.
Yeah. And on top of that, they are aggressively doing share repurchases. They still have $89 million in capacity remaining.
Which is the ultimate signal of a management team that believes the market is undervaluing their strategic pivot. They are generating so much cash from their daily operations that their best available investment is simply betting on themselves.
Right. So we have a company that is navigating regulatory hurdles, shedding unprofitable dead weight on the West Coast, and swimming in enough free cash to buy back its own stock while pivoting toward the tech and energy sectors.
It is a profound structural transformation. The market still largely views them as the people who clean the airport. But their balance sheet shows a company aggressively positioning itself as the critical support layer for the energy transition.
Let's bring this all back to you, the listener. If you take one thing away from this deep dive, remind yourself of the sheer scale of the physical operation here. We spend so much time talking about software and apps, but this report highlights $1.2 billion in new sales bookings in just the first half of the year alone.
Yeah, and that is just new sales, not even counting their existing recurring revenue.
Exactly. The next time you walk through a shiny airport terminal or pass a massive semiconductor plant or hear about a new microgrid, remember that an invisible army of 100,000 people is likely operating behind the scenes.
Because the physical world requires constant, grueling upkeep. Software doesn't rust, but microgrids require relentless maintenance.
Right.
Which leaves you with a final thought to mull over. For decades, companies like ABM were viewed as interchangeable background maintenance, just a cost center.
Right. Easy to squeeze for a cheaper contract.
Exactly. But as our physical world becomes increasingly reliant on incredibly complex, mission-critical technology like EV charging networks and massive battery storage systems, will the companies that maintain the infrastructure eventually hold just as much power as the tech giants that invent it?
Wow. When the technology is that critical, the people holding the specialized tools to keep it running suddenly hold a massive amount of power. It might just be the invisible giant wearing the high-voltage battery pack. Keep that in mind the next time you see someone in a facility uniform. Thank you for joining us on this deep dive.